Hi, my name is Albert Matusek with the Princeton Review, and today I'm going to talk to you about the sources of capital for startups. Let's get started.
So there are a number of stages of startup funding, from the pre-seed capital stage, seed capital, venture capital financing, mezzanine financing and bridge loans, and in some cases, the exit strategy or IPOs or initial public offerings. But regardless of what stage one is in a startup, they need money to keep the lights on and to keep momentum going. But raising money may not have been the startup owner's dream when they began building the company. But the owner's ability to raise capital ultimately determines how far the venture will go. So, let's dig a little deeper at the different stages of fundraising in a startup's lifecycle. The pre seed stage, sometimes referred to as bootstrapping, is where founders use their own resources to kick off their operation. Founders invest from their own pocket. During this stage, the research and development is still being done, and some might already have a working prototype. Funds can also come from the founder's friends and family. The advantage? It's the easiest way to raise capital. If your friends and relatives don't want to give you money, who will? Most friends and family investors will be willing to put their trust in you to deliver on your business plan, no matter how concrete or vague it may currently be. Investing with friends in this way can allow you to keep full control of your business, and it can also be exciting as you embark on your new project with your loved ones along for the ride. The risk? You risk lost friendships and strained relationships with relatives, and your next holiday party may not be as fun if half the people there think that you fleeced them on a failed business venture. In the seed capital stage, the owners try and raise funds so as to conduct market research to know their target customers' tastes and preferences. Also, this can be the stage where the merchandise is launched and also the product is developed with the aim of releasing it within the market. Here, the owners really try to build traction so there's a flow of revenue. Funding for this stage can come from the founder's friends and family. It is often necessary for an entrepreneur to tap into wealthy individuals outside their friends and family, called angel investors. Angel investors are usually high net worth people who invest in startups in exchange for equity or convertible debt, i.e., financial instruments that allow you to convert the debt to equity at a later time. Another way to raise money is through equity crowdfunding. Equity crowdfunding means raising funds from many individual investors by selling shares or convertible notes in a company that isn't listed on a stock exchange. Investors stand to make a profit if the company is successful, but can also lose their investment if it flops. For companies, equity crowdfunding is a great opportunity to not only gain investors, but also comments, feedback, and essentially a small army of incentivized advocates that will strive to make the venture successful. This adds exposure and credibility to the company, and often the initial investors will follow up their investments in further rounds. In this stage, called venture capital financing, there are multiple rounds of funding. This includes Series A, B, C, and beyond. In each round, the startup raises a better value and increases their valuation further. Series A funding rounds are typically created to scale a small team into a larger team that is capable of developing, producing, and selling at a high rate. At this time, the startup should have a product or service and a customer base with a reliable income stream. The Series A funding round is typically used for hirings, equipment necessary for production, and other items needed to create a product at a viable rate. With more of an established presence, this is typically where a venture capital fund will begin investing. Series B funding is the next stage of funding for a startup. Valuations for Series B funding rounds tend to be higher, which means that investors in Series B funding rounds get less equity for their capital simply because the company itself is worth more. The funding in the Series B round is typically used to scale the operations, moving a small business into a larger business bracket. Customer outreach, increasing productivity, increasing availability, and increasing reach are some of the items that Series B funding attempts to address. Series C. During this stage, companies are usually expected to create new products, reach new markets. They may even acquire other startups. As the business is more stable, hedge funds and private equity firms show up during the stage. The funding might continue with Series D, E, F, and so on. At this stage, the startup is growing and looking to scale significantly with a commercially available product. Revenue is coming in regularly, even if the startup is not yet profitable. The funds raised at this point will be geared toward expansion to new markets, M&A, or preparing for an IPO. Investors at this stage want to see a clear roadmap towards profitability. Mezzanine financing is a way for companies to raise funds for specific projects or to aid with an acquisition through a hybrid of debt and equity financing. This type of financing gives the lender the right to convert to an equity interest in the company in case of default. Bridge financing bridges the gap between the time a company's money is set to run out and when it can expect to receive an infusion of funds later on. This type of financing is most normally used to fulfill a company's short-term working capital needs. Bridge financing normally comes from an investment bank or venture capital firm in the form of a loan or equity investment. Bridge financing is also used for IPOs or may include an equity for capital exchange instead of a loan. The key difference between mezzanine loans and a bridge loan is that mezzanine loans are not backed by property as collateral. Finally, companies can raise money through selling stock to the public in what's called an initial public offering, or IPO. The IPO's opening stock price is typically set with the help of investment bankers who commit to selling X number of the company's shares at Y price, raising money for the company. An IPO is not the end goal for all startups. However, going public is an option for a startup to expand further. All of the investors who have traded their money for equity until this point can recoup their investment along with additional profit. Some investors may retain their shares, but many may sell their stock at the beginning to reap the rewards of getting it in early.
So there you have it, the different stages of raising capital for a startup. From the pre-seed stage, known as bootstrapping, where the founder uses their own money in order to get the company off the ground, as well as the money of family and friends. In the next stage, called seed capital, the founders expand their circle of investors to include not just family and friends, but wealthy individuals known as angel investors. Also, they tap into something called crowdfunding, which uses, typically online, a large number of investors to get small funding from each of those online investors. In the next stage, called venture capital financing, a larger amount of financing is raised in a different series of rounds from A, B, C, and beyond, where at each stage, progressively higher valuations of the company raise more funds. In the next stage, called mezzanine or bridge financing, are short-term financing or bridge loans, which helps the company get to the next event, including an M&A, mergers and acquisition, or an IPO. In the last stage, also known as an exit, is an IPO or initial public offering, where the company issues shares to the public and is typically traded on the TSX in Canada or NASDAQ in the US.